Welcome back, everybody. It is Tuesday night, and that means, of course, Vetted VA Live. You were probably all waiting at the edge of your seat for 5 p.m. Pacific, 8 p.m. Eastern, or wherever you may be. We have an interesting topic tonight. We like to plan these out a couple months in advance. And when this was scheduled, and we were going to talk about VA IRRRLs, rates were hitting a 2-year low. We had a lot of IRRRLs coming in. Over the last 3 weeks, rates have gone up. That's been a little paradoxical for people to understand because they started going up within a couple days of a 50 basis points Fed cut. So a lot of people reach out to loan officers such as myself and Brian and Andy and say, hey, the Fed cut, I want to do an IRRRL. And then they hear disappointingly where rates are at. So we're going to talk about that. We're going to talk about why that is. We're going to go into the IRRRL, where you need to be eligible, when it makes sense. And we're going to talk about some of the things over the last couple months that the three of us saw in terms of loan estimates coming over and the way a lot of the call center loan officers like to pitch an IRRRL and what you can and can't do with them. So even though rates are up a little bit right now, and volume for those IRRRLs is down, still have a lot of questions about them around the program. And now is a great time to get your questions answered, get your ducks in a row, and be ready when rates do drop, because we do expect that at some point later this year, sometime in the new year, that we're going to see that window open back up and more people be able to take advantage of lower interest rates, especially those that bought in the last couple of years at rates at 7.5, or even higher. So with that, my guests tonight are Andy Trino in Minnesota. What part of Minnesota are you in?
Minnetonka, Minnesota.
Minnetonka. And Brian Atwood, also a loan officer in Minnesota. What part of Minnesota are you in, Brian?
I'm in Shoreview.
So for all of you Midwesterners, you know where these gentlemen are at. So we're going to get the Midwesterners' perspective on this. Let's talk a little bit about interest rates to start with. An IRRRL is a rate and term refinance. You can't do cash out. So the only reason why you would ever do one is to take advantage of lower interest rates. But Andy, why don't you walk us through what happened with that Fed cut and what we've seen since then?
Yeah, so Fed cut interest rates by 0.5%. So mortgage rates automatically went down 0.5%, right? I mean, that's what everyone thinks.
Yeah.
And in reality, what happens with mortgages? Mortgage rates are changing every single day, and really multiple times per day, depending on what the market is doing. But mortgage rates are trying to predict the future, and everyone was talking about that Fed rate coming, and mortgage rates knew that. Mortgage rates do look to the future. So we really saw our lowest rates, 2 or 3 weeks before the Fed cut their rates, because we were expecting that to happen. Had they only cut them a quarter or not at all, we actually would have seen rates go up. And even though they did cut them by 1/2, they did start going up shortly after that based on other economic data, because now rates are looking forward to, what's the next thing that's going to happen. And, good news for people, unemployment is low and people are working and they're buying things, and inflation is, the bad part of that is inflation is still a thing. And therefore, we've seen rates go up since the Fed cut their rates.
And it's important to understand what the Fed cut is. That is the ultra short term overnight lending rates that banks lend to one another. So we did see some benefits in that in terms of that cut. So the prime rate drops. So credit cards, auto loans, personal loans, that type of stuff has improved, but they don't directly control mortgage rates, because mortgage rates are set by the movement of mortgage-backed securities in the secondary market. And just like Andy said, the concern is inflation. So we've seen a couple of slightly higher than expected CPI report since that Fed cut. We also had a slightly hotter than expected jobs report and a hot retail sales report. None of them were ultra hot, but when we're looking for a cooling economy and things improving, all of the signals that we've got since then have been a little bit negative. So you guys can fill me in on this. Brian, I know a lot of the Midwest is considered a swing state. Is Minnesota a swing state, or does only like Wisconsin get lumped into that category?
I think it's just Wisconsin. So I don't see Minnesota moving too much.
So a lot of what we've seen today in the news, anytime we see these movements, and the movements that are a little bit paradoxical, that don't make sense to a lot of people, they want to say, why? What's happening here? So the betting markets, a lot of the polls are showing that it looks like it might not only be a Trump victory, but a red wave. So we talked about this on our podcast. We did an episode about 3 months ago of do I need to wait till after the election? How is the election going to impact things? And the biggest worry or concern is a red wave or a blue wave. If you get one side in control of everything, both sides seem to like to spend a lot of money, and spending money requires selling bonds, and that is bad for our interest rates. So at least the news of the day on CNBC and other places is saying that there's fear in the markets of a one-sided victory, and Republicans being able to push some things through that would be additional spending. So don't get upset. We're not talking about politics, because really it would be an equal response if it was looking like it was going to go the other way, just be different spending. So from that perspective, let's look and think in terms of what are the things, or what are the clarity that we might get in the next 3 or 4 weeks. We got another jobs report here coming. So the 22nd, so a week from Friday, we had a jobs report. Couple weeks, we have the election. We'll find out exactly how that played out. We don't have to guess at it anymore. Then they'll start guessing of what they're going to try and pass and what they're going to do and how that impacts everything. And then we'll get another look at inflation shortly thereafter. So hopefully in the next couple of weeks, we get some clarity. We see the end of this run up in interest rates, and we have a resumption of that downtrend. But in terms of looking at a VA IRRRL, what are, just in general, Brian, why don't you walk us through what a VA IRRRL is? Obviously, you have to have a VA loan to take advantage of it, but what are some of the features of it? What are some of the requirements that would make you eligible, and how would you use it?
Sure, absolutely. So the IRRRL, right in the name, is the interest rate refinance reduction, or interest rate reduction refinance loan. So it is for those, as you said, that have a VA loan already. And it's a streamlined loan, meaning it's not going through that full cumbersome underwrite. You actually don't need to provide as much details as you would in a traditional refinance. So such as don't typically need pay stubs, W-2s, bank statements if you're not expecting closing costs, things like that. It's a much quicker look, and most are going to be non-credit qualifying as well. So as long as we can get in, they say you already have this loan, you can provide simple details, get that application in, streamline it through. They close very quickly, and it's really just focused on what is the benefit to the veteran, how can we save them money as quickly as possible. So there is to be eligible, there are requirements if you just recently purchased or just recently did another one of these refinances. So there are some waiting periods that we have to focus on. We have to make sure that there is a net tangible benefit. A lot of ways to check that box, but just making sure that is this actually a smart financial decision for the veteran. If it is, they're really simple to get through. They are a fantastic loan. We see that question a lot pop up of what is this mailer I got? Why, looks official, looks government mandated, everything. And it's like, well, it is a real loan and it's a fantastic loan. But as we're going to talk about in a little bit, we have to make sure that what is this real benefit? Are we being smart about it for each veteran's unique situation?
Let's look at that. So, and let's kind of talk about it of how you guys talk to your clients and how I talk to my client, because there's a lot of information out there, and a lot of this can vary regionally, and regionally not because the laws of finance are any different in Minnesota than they are in California, but to a large degree loan sizes are. So this can impact some of these decisions. So Andy, when we're looking at that, the 36-month recoup period that we have to meet, that's a pretty low bar to be able to step over. So why don't you walk us through what that looks like to determine, are you eligible on that 36-month recoup, and then tell us how you advise clients in terms of looking at that, when they should be able to recoup the cost of their loan.
Yeah. And for, we kind of glossed over it, but, that's one of the big things. You got to reduce the interest rate by 0.5% or more, and then you've got to recoup your closing costs in 36 months. So to keep it simple for a guy like me, if it costs you $3,600 to do it, you got to be saving $100 a month. So you got to be able to recoup any costs. They don't want you to be in something, we see it all too often where people are paying points in high upfront fees to meet that recoupment. honestly, if you're only making it by 36 months, it probably doesn't make much sense. Just that's a long time to be in a loan, especially in a market like we're in, where generally speaking, we're expecting rates to decrease. And we don't know if that decrease is going to happen in 2 months after the election, if it's going to be in 6 months next year, it might be in a year. But bottom line, you're probably not going to be in this loan for 3 years. So if it's going to take you 32 months to recoup those costs, that's something that I'll have the conversation with the borrower that I don't want to sit here and you've only recouped half of your costs and we're already talking about a refi again. That may not be the best decision, and maybe we need to wait a little bit.
Right.
So let's look at that. You threw a number out, 3,600, makes it easy to say, hey, I need to save $100 to meet that 36 month recoupment. Again, when we're talking in a forum like this is on YouTube. Anyone in any of the 50 states, I don't think we'll have a lot of people outside of the U.S. wanting to know about U.S. military veteran mortgages, but you could be in any of those 50 states. And the numbers vary a lot. So I'm assuming, do both of you guys do loans outside of Minnesota as well?
Yeah.
Some additional states?
I'm pretty close in Minnesota and the Dakotas.
Okay.
Yeah, similar for costs.
And how do those vary? So I'm on both of the coasts in terms of where we do stuff, and these states can vary tremendously in terms of costs. So Brian, what are you seeing in the states that you're in? Are they fairly consistent? Usually when we see states near each other, they have similar closing styles, similar tax regimes where they're fairly similar, but most of the states you're operating in pretty consistent from
They're pretty
cost
consistent. Yeah. And I usually tell clients that, when we focus on the big ones as far as origination, title fees and taxes that are going to be required, we usually fall kind of right in this $3,000 to $4,000 range. There's a little bit of variable, but that's kind of the upfront little detail comfort number, at least right here.
Yeah, and around the country, at Edge, we're in 47 states. I think I'm in 17 or so. I lost track, but there are some states that have higher costs, so you've got to look at that. Those also tend to be states where there's higher purchase prices. So again, that's where it comes down to. It's more of a percentage thing when you're looking at how many months to pay it back. $1 million loan, saving 0.5% is a much bigger payment, and therefore you're going to recoup those costs quicker. Really what it comes down to, Brian said it. When you're looking, Minnesota, Dakotas, Wisconsin, it's $3,000-4,000 because a majority of our closing costs here are fixed. We've got some transfer taxes that are tied to the loan amount, but they're pretty small. So if you've got fixed costs, the guy here who's doing a $150,000 refi, we got to save him a much bigger percentage than someone who's got a $500,000 loan, $600,000 loan. 0.5% on that $600,000-700,000 loan, that's going to recoup a lot faster because the closing costs are fixed. So a lot of them.
Yeah. So with that, it's really important to know where you're at. My favorite is Florida. Florida has low priced areas, high priced areas as well, but they have an intangible tax and a mortgage tax. And you look at it, you're like, someone in the government in Florida said here, whenever our state residents have an opportunity to save some money, we should get some of that as well. We already taxed it when they bought the house, but if they have an opportunity to save money, the state should get some as well. And they're not alone. There's a handful of states that have those taxes, a handful of states that have significantly higher title fees. So it's important that you don't rely on Googling or looking at online articles because they're going to give you crazy broad numbers like, 1 to 3%. If you have a $300,000 loan, that's $3,000 to $9,000, and any and all of those can be true. But when we're talking about this, and knowing, first of all, do I meet that 36-month recoup? But then even above and beyond that, that's a pretty low bar. We want to make sure this makes sense for you with your timeline and what your plan looks like. So, Andy,
Getting online advice like that's like buying a one-size-fits-all t-shirt. Someone's going to end up looking awkward in that thing, and one way or the other.
Everything is super general. Like I get people to call all the time, and I'm sure you guys do too. Well, I was looking at this house and Redfin says my payment's this, or Zillow says my payment's going to be this. And you're like, well, the insurance was either exorbitantly high or exorbitantly low. The taxes were off. It gave you a crazy interest rate. So looking at that, it is important that you're dealing with professionals that can narrow those numbers down and that are familiar with your state. The big piece that can really come into pushing that recoup out, but increasing your monthly savings. Andy, you and I were talking before we came on the show here. I saw probably 30 or 40 LEs from other lenders over the 6 or 8 weeks that we had rates really low. And when you're dealing with a call center lender, someone that's advertising on TV, someone that pops up number one in the paid Google search, you are dealing with a kid in the call center that they want their interest rate and the monthly savings to look as attractive as possible. So one of the big ways that they do that is quote this low payment, ultra low interest rate, and then gloss over the fact that their box A fees includes 1 3/4, 2 points. And people always ask, for us in the industry, you just think everyone knows what a point is. It's a percentage of your loan amount. So for a veteran who bought in the last 2 years with 0 down, it's essentially 1 to 2% of your home's value. So you're going to give up a couple percent. You know, the way I like to compare it for veterans is very, very rarely do I have a veteran on the 0 down purchase say, I would like to pay an extra 1 to 2% to get a lower rate. They're like, I have a limited amount of money. I'm doing 0 down. Give me a 0-point loan and get me into that property. But I also have them come back 18 months later. Hey, I can lower my interest rate. What do you think about this loan estimate? The best example I have, a lady veteran had sent in, she goes, I'm just having the hardest time deciding. And I look at it, and she was in Texas, and it was from a call center here in Orange County, California. And I'm like, you listen to my podcast, you want my advice on this, but you called a kid in the call center here near me. And the terms were actually good. The terms were not bad, which, you can get the downside of low expertise from dealing with someone in a call center and getting bad terms. She was at least getting good terms, but they were giving her no insights into which option was going to be better for her. So the one, and at this time, these were good rates. Rates had already popped up a little bit, and she had them locked, fortunately. So they got her locked, and they were giving her no guidance on 4.75 at almost 2 points, 1 3/4 points on a $400,000 loan, or 5 1/4 at 0 points. So Brian, is that something that you see a lot from either competitors online or local, where they're trying to push these ultra low interest rates? And you may say, if you have a 3% rate and you're watching this, you go 4.75 is not ultra low, but it is for those people that were coming from a 7 1/4 that they got 18 months ago.
Yeah, I not only see it with other offers that are out there. I was cleaning out my office the other day and found my old loan estimate from when I bought my house before I was in the industry. And I'm like, I paid what? Right? These are no cost refinances, right? So just for everyone, they're absolutely not. These loans always have cost to them, and it is so easy when your goal is just to get the loan funded to add in those extra points and push it down. The market might be exactly at the same spot that you were in. But sure, by adding extra fees, you can push that down a little bit further, and it feels better, right? Because the rate went lower, especially if you extended your loan back out, you might see some big change to your payment. And I just point out, these aren't terrible things in and of themselves, but you need to be aware of them. You need to be aware of what you're paying for. Does this actually make sense for you? Everyone's situation is different. But at the end of the day, this is a sales industry. So when somebody is calling, feels like they're giving you warm and fuzzies and they just really want to help you save money, there's a pretty big benefit for them there too that they're trying to take advantage of.
Yeah, and a big thing that you said, so many times you hear people say things like no cost, and really it's just no cash out of pocket. And that's so important to pay attention to, because it feels like you're not paying anything if you're not bringing cash to closing. But those 2 points, so 2 points on a $400,000 loan, you're talking about $8,000 being added to the balance of the loan. And a lot of people don't realize it. And, it's so easy. You're signing 30 times at a closing table, and you kind of just go on with it. And all you know is I'm saving money, and, 4.99% rate, that seems great. Yeah, that just cost you $12,000 that you're going to pay back over 30 years. It's going to cost you 20 grand to pay that back. And people don't realize it. So there's no such thing as a no cost refi. It's being added to your loan balance. You really have to pay attention to everything there.
It is really important because, again, the VA loan's unique. really the only broad-based available loan. I mean, USDA is zero down, but it's the most common zero down loan. So if you bought 18 months ago that $400,000 home, you've only paid $1,000 or $2,000 down. So and if you were not funding fee exempt, you were already over 100% to begin with. You've only paid a little bit of it down, and the VA is allowing you to finance, assuming that you have the monthly payment savings to meet that 36-month recoupment. They're allowing you to finance these costs. So from call center loan officers' perspective, the worst conversation they want to have is, well, do you have money in the bank to bring in $9,000? So there's, one of the other ones here that's really unique. Texas and other states that have their taxes due only one time a year. We get late in the year like this, and those impound accounts have a ton of money, especially Texas. Not only do they only pay them one time a year, your taxes are relatively high, 2.5%, sometimes close to 3%. I had a guy that had $15,000 in his impound account, and he's like, I don't have $15,000 to bring in right now. But that was the window that we had. He was fortunate that we were able to have him reach out to his servicer, and they made the tax payment early, even though they're not due for another month or so. They paid that, and we were able to bring down the amount of money that we have in there. But we all deal with one of the biggest wholesalers in the country, and they don't require veterans to have an impound account, but the vast majority of lenders do. So if you're going to have that impound account, it's another thing to factor in here. You can say, so even if it's a true no-cost loan where you're taking a slightly higher interest rate and we're covering all of those costs for you, it doesn't mean that those prepaids go away. You're going to have prepaid interest. You're going to have prepaid taxes. You're going to have prepaid homeowners insurance. And this run, I don't know if it was the same way for you guys, but this run for me, it seemed like everyone was right at their insurance being due and the taxes coming due here in the next couple of months. So we had really, really big impounds for all of the IRRRLs and streamlines that we were doing here recently. So it's another thing that you have to factor into it. And hopefully your loan officer is asking you, okay, you're reaching out because you want a lower payment, but there's a balance there. What do I owe versus how low that payment goes, and where does that fit over your plan and how long you expect to be in that home? Because it's important to manage your equity and not just the cash flow in terms of the monthly payment. Let's take a look. This, I don't know how much it came up for you guys, because really, if we look back, I just looked at like 5 years worth of my closings, and it's easy to forget that 2.5 years ago, we were closing loans in the 3% range. So
I remember. I don't forget.
So those people are highly unlikely to need to refinance just for a lower payment soon. And their rates are so low that they're probably not willing to do a new mortgage to get cash out. So the IRRRL doesn't allow you to get cash out. And most of the folks that we've done VA purchases the last couple of years, unless it's someone who's built up a bunch of equity, there's not a lot of equity there. So are you guys seeing many inquiries for cash out VAs right now?
Not on the VA side. We have the conversation sometimes, and like you said, there's just not the equity there. I've seen some where people have been in loans longer, and there's, big chunks of other debt out there. And really with that, you got to look at, what are we paying off? What's the rate that we're paying off? If someone's got 20% debt, that's, say you got $100,000 in 20% debt and $100,000 at 3%. Well, you look at that combined debt, and you're actually, your cost to you is actually 12% to borrow all of that. So doing a cash out for someone like that might make sense. I've had people come to me that want to pay off $10,000 worth of credit card debt, and they've got a $300,000 mortgage. There's no way that I'm going to let you get rid of 3% rate on $300,000 to pay off $10,000 in credit card debt. That's insane. Now, someone else out there might be willing to do that for you, but I'd like to find them in a back alley and have a couple words.
And it is a lot of the clients that reach out. We ran up some credit cards. I need some cash out. Okay, well, how much do you need? Like $14,000, and not the $14,000. It's a substantial amount of credit card debt at current interest rates, but relative to your $200,000, $300,000, $400,000, $500,000, $600,000 mortgage, it doesn't make sense touching that and going away from it. I think maybe one of the things we probably could go into a little bit more detail for folks here, because one of the things that they don't understand, I had a veteran that unfortunately we weren't able to help because they just closed in July. So she reaches out and goes, "Hey, I'm at 6.875." I'm like, "Oh, awesome. We can get you a much lower rate." Well, she had just closed in July. So Brian, maybe walk us through what that timing looks like and what people need to be aware of. And probably more importantly, if you could tell us why did that guideline come about? If I can save money, why does the VA say, "Hey, I have to wait 7 months"? That piece sounds crazy.
I don't
That,
know why
hey,
I lost sound here.
Ringtone is that. Just
Let me
kidding.
mute myself.
But no, yeah. So there are waiting periods when wanting to do refinances or just use your VA benefit again. Period. They want to make sure that in the mortgage that you have made 6 payments and that a full 210 days has passed since that loan closed. So we want to make sure that people are not that we're being smart on these purchases up front. But outside of major life changes, not a lot should be happening in that next month or two. That's going to blindside us, and then adding on extra fees and adding on extra process for that veteran to go through. So it's always going to be that 6 months and 210 or 6 payments and 210 days. So we got to make sure that we're waiting.
And the reason for that is it sounds terrible because you, as a veteran, you earn through your service this benefit. Well, there were businesses that were set up to basically take advantage of veterans that when your loan closes, the deed of trust gets recorded. That's a matter of public record. And it shows on there that it's a VA loan. So anyone can see, hey, that's a VA loan. And what would happen, veteran would close a purchase and the next month their mailbox is getting flooded with offers of, hey, we can get you 1%. And you're like, well, rates were never 1%. So what they were doing, taking people from a 30-year fix to an ARM, charging them several points, financing them into the loan. So all of these guidelines that we have, the waiting period, so you can't be doing 4 and 5 IRRRLs within a year, the requirement on the recoup that you can't charge someone a bunch of points to give them this monthly payment savings to get them down to that 0.5% savings and interest rate. They're all there to safeguard things. Unfortunately, sometimes we get situations like that lady that I was dealing with that were like, hey, I cannot help you until the middle of January. And we're going to find out for her if the savings is still there in the middle of January or if rates continue to trend up. Andy, we had talked about this again a little bit, just all of these offers. What should a veteran expect when rates dip and they have a VA loan from the last couple of years? What are some of the fun little things they're going to see in their mailbox, and what are the questions they should be asking if they decide to reach out and talk to someone on that front?
They're going to get postcards and letters and little things that look like credit cards and mail that looks like it's from the federal government, mail that looks like it's from the VA, mail that looks like it's from their current lender, mail that has my name on it if you worked with me, mail that's got Brian's name on it if you worked with Brian, mail that's got your current servicer's name on it. A lot of things to try to trick you. And immediately, red flags should go up when you see that stuff. It is illegal for them to pretend like they're our government agency, but they still do it. And not surprisingly, the ones that are bending or breaking the rules tend to not have the best deals out there either. And like you said, even if it is a good deal, they usually don't have knowledgeable salespeople either. So even if it is a good deal, they can't really explain it to you that well. Really what I tell all of my clients is when they get that stuff, call me. And sure, I'd love to do the loan for you, but I'm also going to tell you if someone else out there has a better deal than I do. I'll take a look at it. I'll analyze it. I'll explain to you what it is. If there's something different that I have, and it may not be better, it may be different. They might be offering an ARM, like you said, but we'll look at it. We'll decide what's best for you. And, that's just kind of a point for you to reach out to someone that's knowledgeable and can explain it to you.
Absolutely. Brian, so we've done a really good job here of just giving broad overview. Who's eligible? When do you use this? Why would you use it? Why was there a big influx of them a couple of weeks ago? Why are there less of them now? But we've talked about what you shouldn't do or what you should look out for. Why don't you walk us through? Josh, the veteran, calls you up and says, hey, I bought last year. I'm in a 7.25% interest rate. I would love to take advantage of these lower rates. What should that initial conversation look like, both the first call and if we go through it and it looks like there's a benefit there, what are kind of the first steps to get your IRRRL going?
Yeah, the first thing is just getting to the numbers, really trying to figure out what that benefit is, figure out what the potential new rate could be, and see what is that difference going to be. So there's a quick way to kind of go through. It's easy with the IRRRL, since we don't have to dig through too deeply to be able to price things out and say, hey, this is probably where we could get you at today. Here's where you're at. We can probably save you a couple $100 a month, give or take. Does that sound like enough? Does that sound like it's beneficial for you? If it's going to cost $3,000 to $4,000. Again, as we said before, whether that's coming out of your pocket or just being enrolled into the loan, that's still a cost. So we want to make sure that initial benefit is there. Like, you know what, this sounds really good. Let's get the application going. Let's jump in. Again, very simple application. We actually don't need to be as thorough and detailed. I know with some lenders, they will say just leave the income and assets blank. We don't really need them. So that's going to be specific to the lender, so don't be surprised if they want that. I've seen people and talked to clients who say, like, oh, I had to dig up paperwork from forever to do my last IRRRL. It shouldn't really be the case, but that might be specific to that actual investor. So just knowing that initial, as far as what I would recommend if you're talking to anyone else, is understand what those potential savings are and understand what those costs are, right? They're always there. Make sure that math makes sense. And hypothetically looking to say, hey, now if rates continue this trend, which we hope that they will, things are starting to go the right direction, likely going to for the next several years. If we were looking to do this again in another 210 days, is it still going to make sense? And trying to figure out when that time is that's going to be the best for them. So it's tough because it is unique for everyone. What that number is, I've had people that can save $400 a month and say, like, you know, I want to feel it out and just see a little bit more, see what next month does. And then others that are like, wait a minute, $50, I can say that right now. Like, yeah, the math really isn't mathing right now, though. So it's figuring out what is your goal, where do you want to be, what's that savings going to do for you, and understanding the cost that goes with it. If that all makes sense, it's a very simple process as far as getting your application in. It is streamlined. It's minimal documents. We can usually get this in as long as you've got mortgage statement in hand and you've been making your payments, get your IDs and insurance, and your loan officer can gather the last few documents and drive it home for you.
And it really is. I mean, when you say it like that, you're like, it really is that simple. 3 or 4 pieces of paperwork, complete the online application. And, you know, depending on who you're working with, how streamlined they are, how streamlined the title company that they're working with, you know, we can close these in as quick as a couple of weeks. Most people don't need to close them that quickly. It's somewhat surprising to borrowers to find out that oftentimes the borrowers are the reason why it takes 30 days to do something. But if someone's motivated, jumps on it, because there's not a whole lot of back and forth without all the documentation required in a normal loan, without waiting on an appraisal to come back in, you can get these done fairly quickly, and that can be super beneficial for you. Andy, anything to add there just in terms of that application process, initial consultation, what someone should be talking to their loan officer about if they're considering an IRRRL?
You know, Brian kind of nailed it. You know, it really comes down to what the savings are and what the costs are. And, you know, one thing I'd add, sometimes it's easy from our chair to try to judge what's a good deal for someone and what's not. Because I've had those families with smaller loan amounts, and $75 a month is a big difference in their budget. And it's easy to say, oh, maybe that's not worth it, but present it. And as long as it's something that, again, not just meets the recoupment, but maybe is on the shorter end of that recoupment, present it and talk with them and how that's going to change their life. Because sometimes something that doesn't seem like a big savings from our side might make a difference for that family.
Well, you said something really important there. Had a couple of clients here recently that didn't know. They're like, you know what? I am confident that the rates are going to be lower next year. I don't know if I want to do this. And we go through the numbers, and the recoup was at about 7 or 8 months. So I said, I don't know that I'm really willing to bet anything that anything's going to happen in the next 7 or 8 months. I didn't think rates were going to go as low as quickly as they did. I certainly didn't think they were going to jump back up as quickly as they did. So that's from someone. I watch it every day. I pay for 3 different services of experts that follow this and give you analysis every day. So when you're looking at that, I like to say, if that recoup is at 7 months, 8 months, 9 months, and we have to be in this loan for 7 months, you're going to get the vast majority of that. So if it's an extra $1,000 and exactly at 210 days, you have the ability to drop the rate another 0.5%. Just look at that additional $1,000, $1,200 as insurance that we were wrong, that rates never came down anymore, that you were able to save that $250, $350, $400 a month there. I think people, when rates are going down, they get really cavalier about, nah, rates are definitely going lower, I'm going to hold out. And then on the flip side, people panic. So I have people that were convinced rates were going lower that wouldn't lock at 5.25, that were calling, making sure that I got them locked at 5.75 on the way back up. And it's literally in a matter of 10 days, the guy who's like, I'm not doing anything until rates hit 4.75 with 0 points, are calling at 11 o'clock. Did you get my rate locked today? Did you get my rate locked? So it definitely is unique and individual to the person. Talked to a gentleman in Ohio just this afternoon. I said, okay. I said, there's really not enough savings right now. We need rates to go back down so that I know what that looks like. I said, where do you feel like the monthly savings needs to be at? He goes, I think I'd like to save about $1,000 a month. I said, did I miss something? Does he have like a $2 million loan? We go back and look, it's a $600,000 loan at like 7%. So it's a high rate, but it's not exorbitantly high. It's a decent sized loan, but it's not huge. So again, part of that conversation, what we did is, okay, if we got to 5.5, this is what it looks like. If you got to 6%, you're still saving $420 a month. I don't know where you come from, but for me, $420, I will do a little bit of work. I'll pull some paperwork together to save that. And we're talking if it got 6% and 0 points, which that's not a big move for what he needed to do there on a conventional loan. So from that perspective, it is really important to have that conversation. So tell me this, what are you guys doing right now with folks who reached out, thought they wanted to do something, weren't sure, wouldn't pull the trigger, and now that rates are up? What are you doing for those people who missed this window but have raised their hand and indicated that they would like to get in if they have an opportunity? You have any systems in place for that, Brian?
Well, just a lot of conversations that we're having. We definitely had some people that were on the fence and looking like, okay, we can get down into that low fives a couple of weeks ago or closer to a month ago, but keeping that waiting, and now it's jumping up significantly. So, we have a lot of the groundwork done. So if, fingers crossed, if things start to improve here in coming weeks, then we might be able to still move forward. But it's important for any loan officer to have that conversation with their client and say like, hey, maybe this did make sense. We didn't have anything locked, and it just doesn't make sense anymore. I don't feel good about this loan. And for anybody that might be in that refinance process right now, make sure that things on your loan estimates and closing disclosures haven't changed. Because if you were not locked into those rates, and even over this past week, it's been pretty ugly for rates. So you might see some significant increases over the past week, and they might still be showing you the same rate, but suddenly a lot more is being added to your loan. So just have to be really, really careful in looking at that. Make sure you're comparing what were these costs before and after, what were these loan amounts before and after. But as far as existing client base, it's something that we monitor. I know all of us do it in different ways to keep track of current client base, and anyone else that wants to try and keep an eye on things. It's tough to keep track of the market. Again, as Andy said earlier, it changes every single day, sometimes multiple times per day. And when that opportunity comes, if you have a certain spot where you want to do it, then you should have somebody helping you keep an eye out for that.
And it can also be a little bit freeing to have that conversation now. So when we're having the conversation, well, hey, I'm going to do this. Do I do A or do I do B? It's somewhat a little bit freeing to sit back and go, hey, we're out of the money right now. We're not even going to do this. Where would you need to be to make it make sense? Because again, that pressure of the moment of feeling like, oh my God, I don't want to mess this up. I don't want to make the wrong decision, versus just being able to say, no, if I get to that rate that saves me $312 a month, that would make a difference in my life. I can increase my 401k contribution. My kid can go to private school or ballerina lessons, whatever it may be. So there are tools out there for tracking that. Some loan officers will throw it in a spreadsheet and just say, hey, Jane and Joe want to be at 5.25, and you can watch that. We can price things out every day. I have a tool here that we're taking people just saying, please send me in your mortgage statement, so I know exactly what you have. When did you take out that loan? What is exactly your interest rate? Because one of the things to me that is shocking, borrowers in process are very acutely aware of what their interest rate is, and if it's locked and if it moves 0.1%, they're going to be really unhappy. but they've been in their house for 4 months and they don't remember what their interest rate is. So they may think it's 7 and it's 7.25. They may think it's 6.875 and it's 6.625. So it's important that we get a look at that mortgage statement, know where you're at, and have that conversation of knowing where that target or strike rate is, and have a system to ping you when that opportunity arises. So from my perspective, that is the plan for right now. Unless you got a really ultra high interest rate, you're probably in a waiting period, but it can be a good pressure-free time to reach out to a professional expert loan officer, loan advisor, not a salesperson sitting in a call center. So if you're here watching this in Vetted VA, we have a huge group of professionals that cover the entire country. Reach out. Any of us would be happy to go through the numbers, get you accurate numbers in terms of your state. If you have a quote from another lender, be able to look at that and tell you, does this make sense? Is this good? Is this out of line? I had one just this last week that someone was getting overcharged about $6,000, and thought for sure we were going to be doing the loan for them, but they took that information back, went to the lender, and they did the right thing and gave them a $6,000 concession magically. They didn't want to lose that loan. So we're all happy to do that and go through that information. So we've done a pretty good job of covering everything here on IRRRLs and what's happening with the market. I always like to give you guys a last shot at advice on the current market, IRRRLs, anything going on your mind. So Andy, we're going to start with you, and we'll let Brian, for his first visit here to the Vetted VA Live, have the final word.
Yeah, I think you've covered a lot of it. Rates aren't where we hope they would be, but that doesn't mean, don't have the conversation. Have the conversation, come up with a plan of where you feel comfortable. For better or worse, sometimes the analogy I use is it's like being at the casino. If you go in there and you're just, willy-nilly, you can end up losing a lot of money. But if you say, hey, when I get up $500, I'm going to leave, you're more likely to leave when you're actually up. And that's kind of where we're at now. Come up with a plan. You don't want to be that person. Your example was rates were 5.25. He's waiting for 4.75. Well, he didn't walk away from that card table, and now he's at 5.75. So it cost him 0.5%. Get that strike rate, talk to a professional, get on their radar. So when you hit that, whatever it is for you, that's going to make the difference. 5.75, 5.25, whatever that is, put that out there so somebody's watching for you. Because what you're seeing in the mailers, what you're seeing online, it's never what's really going on in the market. So have someone on your side who's looking out and is going to reach out to you when the time is right.
Perfect. Final thoughts, Brian?
Yeah, just kind of adding on, really, Andy nailed it. It's just the timing is going to be unique. It's going to be to your situation, what the savings is going to be for your family. That's different for everybody. We see a lot of questions in Vetted VA and elsewhere of like, what's the right rate to get to? When's the right time to do this? What's the right savings amount? And that's different for everyone. And the other part is just understanding that your life situation is not going to align with the market perfectly. There is no perfect time. We have to figure out what is the maximum benefit, what is your goal that you want to get to make any of these refinances make sense. So everyone's situation is going to be different. If you just say like there's a dollar amount or it's a time, or maybe there's some other life situation going on that this would provide a big benefit to you for, then fantastic. Have that conversation. But lastly, our pretty much anyone Vetted VA is as far as the veterans that are involved, we don't expect you to be an expert, right? We spend every single day analyzing this, trying to understand it. And even when we get it wrong, is sometimes trying to understand what the market's going to do. So don't try and go at it yourself. Don't try and just Google the answers or respond to a flyer or post on social media saying, what's the right thing for me? Because you're going to get a whole wealth of different answers. So have that conversation with somebody that you trust is going to have your best interest in mind, your family's best interest in mind. See when is the time to make any real estate related moves, any lending related moves, and we can have that conversation and figure out what that situation is for you.
Perfect. All right. Thanks for sharing your insights and information tonight, gentlemen. For those of you who are here watching, hopefully you found it helpful, and hopefully you've taken notes, because we are most likely going to get another bite at this apple. It could just take a few months. If we look back, history doesn't always repeat itself. But when you talk about an election kind of throwing things off, the election is settled in November, but we don't really get a new president till January, and it's going to be first quarter of next year before they really start rolling out what it is that they would like to accomplish, and then the market can absorb and adjust and think what's going to happen. So don't know what's going to happen over the next 1 to 2 quarters, but definitely feel as though there's going to be an opportunity. So definitely get ready, take advantage of it now. Again, Andy, Brian, thank you for joining us. We will be back next week with a whole new set of vetted pros to answer another set of questions. All right. See you guys next week.
Thank you.
Thank you.